Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Phil Mackintosh, Chief Economist at Nasdaq. We have Max Cabasso, Managing Director on Nasdaq's Market Intelligence Desk, as well as Mark Baran, Managing Director of the National Tax Office at CBIZ. We're here to discuss tax policy after the first 100 days, including capital gains, income tax changes to the IRS, and the impact to investors and the economy. Certainly a lot to unpack here. It's great to have everyone with us. And Mark, regardless of who's in the administration, there's always going to be an impact when you think about tax policy. So on a high level, where are you focused when you think about what the first 100 days look like and what appears to be the most impactful?
Sure. So the first 100 days, we really were just thinking about what the priorities are.
Right.
So what is Congress looking at? What is the administration looking at, and how is this shaping out to be? We have a general idea of that. So what's happened after the first 100 days is really a product of what happened in the first 100 days. We have a budget process in place right now. We have a bill that's likely going to pass. What's in it? We don't know yet.
I mean, it's got to be challenging in the tax business when you're thinking about advisory and what's next, and what you're telling clients and so forth. Is there what do you think might happen? Let's put it like that.
Okay. Well, I don't have a crystal ball, but what I think is going to happen is before the recess, Congress managed to enact a concurrent budget resolution, which unlocked the reconciliation process. For those that don't understand that's a process that needs to be done that avoids a filibuster and Senate rules and allows legislation to go forward. It's been process oriented. We've been thinking about the process. Now the hard part comes, crafting legislation to meet the instructions and all the budget construct that's in the budget resolution. This is the hard part now. That's the policy. So there are groups and there are priorities and there are efforts. And we tell our clients, we tell our practitioners, don't assume we're just going to have an extension of TCJA. Don't assume that we're going to have all these other items. They might be in there. They could look a little different. So in terms of prognosticating on what's going to be in a bill, I think we have the general idea of what's going to be covered. I can talk about some of those issues,
yeah.
but really it's going to be how impactful is it going to be? How far are they going to go? Where are they going to cut back? Where are they going to find offsets? Then we'll get a better idea of what a bill will look like and what provisions will remain and what will go by the wayside.
And certainly feel the economy is going to react off of that as well. I mean, it's going to have implications.
Tax is kind of economics 101, isn't it? If you make something more expensive, people will buy less of it. And if you give people more money, they will spend more. So at the end of the day, the things that the government can do in terms of pulling levers are quite powerful. And I've spent the first 100 days focused a lot on the tariff changes because that's being implemented as we speak and talking to companies. And so the companies are trying to work out, like, if it's going to cost them more to bring goods into America, when does it become worthwhile building a factory here and hiring American workers to make things here? Or is there another country where you can source something slightly different, complementary sort of good that'll let you keep running your business? So there's going to be changes in the supply chain. We saw that in 2018 when we had just the China tariffs. So you basically can see like supply and demand in action as you change tariff policy, as you change tax policy.
Yeah, and of course corporates are going to be impacted.
Yeah, and I think going off that though, it's still just another sense of uncertainty at this point. I mean, we look at first quarter earnings, they've been pretty positive, seeing earnings growth, but the guidance that's coming out there is the question mark. Who's issuing guidance? Are you issuing a single set of guidance? Are you issuing two? There's the tariffs, tax policy, everything is just more uncertainty. I think it's very difficult to manage through that. You're going to see a lot more probably cost-conscious companies or corporates that are saying, we don't know what's coming. We're going to kind of manage our positions to make sure we're able to get through no matter what it is. Maybe then if we get more clarity and it's what they expect, back half of the year is potentially have a bit more green shoots. But again, in the face of uncertainty, it's going to be that cautious nature. Let's hang tight, make sure we're in a good capital position, and then we can try to deploy in the second half of the year if we get clarity. Obviously, we saw the tariffs April 2nd. Everybody thought one thing, poster board comes out, and it's, wait a second, this is not what we thought. We need to reconfigure. So I think it's going to be a bit more cautious before kind of redeploying and making
even what the stock market did. Straight after the election, the stock market went up because we were thinking lower taxes on companies, that's more profit, lower regulations, that's less costs, so that's going to be good for the economy. And then the tariffs came out, and suddenly everyone's like, well, that's actually extra cost. Some people might buy less, some people might produce less, it might slow the GDP down, and so the market really has been following the sort of the initially the lower tax spectrum of extra revenues and then the tariff costs in terms of what's going to do to revenues.
I don't think anyone was necessarily expecting this type of scenario.
I think that, well, especially the April 2 announcement, the rate that was implemented in a lot of countries was well above what economists were kind of baseline forecasting. And so the shock of how much more expensive things to import were going to be was really why the market kind of panicked, to be honest.
Yeah, it did. The American tax system is so complex as it is, right? I feel like we continue to make it more complex. There could be ways to simplify it.
There could be, but I want to touch on the tariff issue. What's interesting is this Treasury Secretary just yesterday was indicating that the tariffs are a revenue raiser such that it could offset some of the tax cuts that are being proposed. Now, that can't be scored in a CBO scoring, which is required for a tax bill, but it's being talked about. So you know, those issues have come up. There's certainty that we're looking for. The markets were probably looking for certainty. We as practitioners are definitely looking for certainty and less complexity. So to your point, the tax laws have become overly complex over the years. And if they put together a hybrid bill, or if something comes together where there's different dates or there's different portions of it to meet budget guidelines, you will have more complex compliance going forward.
Right, and that's what's confusing to me. Seeing tariffs as a revenue source seems a bit confusing, particularly if there's tariffs on, you know, on the other side. It zeroes itself out.
I agree. I'm just telling you, the Treasury Secretary has indicated that this is an item that they would like some of the budget deficit hawks to consider if they're worried about the budget.
Because I mean, it's going to change, you know, debt analysis and everything around a company, what can be deducted, what can't, planning considerations, and what your structure looks like. I think it's you know, from a corporate perspective, it's a tough operating environment.
That's right.
Yeah, I mean.
Yeah, I mean, we always talk about making it easier for companies to list on, you know, public exchanges, to be public, and kind of getting rid of some of those overhangs and the need for more compliance, more manpower behind actually going. And when you get more complexity, as we all know, it takes more manpower, more people in analyzing to actually get through those processes. I know there's talks now potentially going from, you know, quarterly reporting to biannual and to kind of lessen some of the burdens. But again, right now there's no real certainty on it, and it's just more complexity, and it's just going to take more and more.
And the companies that are deploying capital really need some of these tax incentives that have been considered a priority.
Yeah, well, what's going to happen is you're going to turn that faucet off, right? If you don't understand what that environment looks like. And Phil, you noted it in your note today, the rush to import goods could, you know, mathematically skewed GDP.
Yeah, massive increase in the trade deficit, which sounds like the opposite to what we're trying to do with tariffs. But what it actually did mathematically was made the GDP look weak in Q1. That'll reverse itself in Q2.
Right.
But of course, the market today is looking at the negative GDP and thinking recession, because in, you know, a lot of people's minds, 2 negative quarters of GDP is a recession, and so we've just had one. But really, it was a mathematical quirk created by people trying to bring those imports into America before the tariffs on them. Yeah. And now what we're starting to see, if you look at some of the freight, is there's a lot like a slowdown in the shipping, because the inventories are already here, and we won't need more for a little while. So it's created an interesting supply chain dynamic. It's created really weird GDP data. It's created really weird inventory data. And
employment data and consumer data, though, is still relatively strong.
Almost all the hard data is from
job so
March,
hard.
and that's the problem, right? Because the April 2 tariffs, like you said, were the big ones that shocked everybody, much higher, much more costly, going to impact supply and demand more than all the other things that were done before. So the hard data that we're still getting is March data. We haven't really seen anybody factor in what's going to happen in April. And really in April, we had those massive tariffs, and then we had the 90-day delay a week later. So for a lot of companies, it's not as bad as we thought in April 2 yet anyway.
Right. Well, I mean, if guidance serves, you know, which it does, of course, looking forward, I mean, the guidance perhaps suggests that Q2 is going to be a bit of a challenge.
Yeah, for sure. And again, just the number of companies that are just not providing guidance. I reached out to a few, you know, if they had any comment on it, said, you know, we can't comment what we're doing, but we are looking at what other people are saying more to see kind of the leeway. You know, they obviously, when full year guidance is different than the next quarter, but you know, they have certain guidelines of how tight they want to give guidance, and now everything is much wider. You can drive a truck through it, or there's 2 different sets. We saw with, I think it was American Airlines, they said, you know, if-and scenarios. If this is right, this is kind of how we think it's going to go. If it goes the other way, this is what our guidance is going to look like, which is pretty much unheard of. So again, it's really just that uncertainty. But first quarter is pretty good. We're still seeing earnings growth and sales growth. So we'll see how much this actually impacted. I mean, this is more anecdotal. I have a friend that's in a manufacturing industry for metalworks, and they're actually seeing a lot more demand coming in for people looking for U.S. suppliers. So how much that impacts him, he has some of his parts that are going up in cost, but again, the demand for his services, because he's U.S. based, is a bit of a benefit.
I think that's an important point. Like, there's winners and losers, and we're kind of obsessing about talking about the costs and the losers.
Right.
But there will be people that are better off. Yeah. Someone that's a domestic manufacturer will suddenly be more competitive versus other imports that were coming in and competing against them. And so there's a couple of scenarios that I'm starting to see now where, like, to your point, if this, else that, but there is scenarios where maybe all of the different countries in the world start to invest in themselves, invest in their own infrastructure, build out better supply chains internally, and that increases wages, increases employment, increases output. It's actually net positive. And so that's a really nice scenario if that's actually what happens. I think the consensus is, at least in the short term, the uncertainty that you keep talking about kind of makes everyone sit on their hands and not do anything, and not doing anything is anti-growth.
Well, I mean, we ripped the Band-Aid off right away. We could have been, guessing what would happen over the next couple of years if it wasn't enacted, or the strategy wasn't enacted right away. Do you want to contemplate for 2 years instead of like knowing?
Yeah, I think that's part of the calculus that the administration made. I'm guessing there, but that it was about speed first. Because if it was slow down, wait for 2 years, then there's more people, more cooks in the kitchen, more questions, more blockages. They say, we're going ahead with this, we're getting it out there, ripping the Band-Aid off, and this is, we're kind of showing the cards in a sense of this is where we're going, and we're not stopping at the roadblocks. Let's get it out there now where we see it. Now again, we have to digest it, see what actually comes of it. There's obviously negotiations going on, but getting it out there, it wasn't a 2-year process like we had a few years ago with the Chinese trade war. Is it going to happen? What's happening? Tariffs, and it was just kind of a delay, nothing. This is you're getting what you're getting now.
So what happens, Mark, if nothing materializes from the tax policy in the next 100 days? Is that a possibility, or?
Well, the Treasury Secretary has indicated, and members of Congress have indicated they're going to move quickly, even though it's a compressed schedule, legislative schedule, and they're targeting July 4th. So, and that's somewhat tied to the debt ceiling. We may reach that debt ceiling by August. So I think they want to get this done as quickly as possible. Whether they can make it to July, I think they could. Yeah. And it really all depends on whether both members, so both houses, both chambers of Congress can get together, agree on what should be in a final bill, and the numbers make sense. And if they can do that, it's taken them a while to put together the budget resolution, a couple months. So we're talking about a couple months. If you look at the calendar, it could happen.
It's almost like there's fatigue in a way, which, the pendulum always swings one way to the other, but if the fatigue might be, okay, let's come together, figure this out, let's be rational and kind of keep the politics out of the policy, which is what you brought up before, which I thought was a very poignant opinion to have here. Phil, I want to go back to the story that Max had just spoken about before, where it almost gives businesses a little bit of a cushion if they do have to raise prices because of cost input. But supply demand, the market's always going to work like that. If the demand is there and you're the only one supplying, it kind of gives you a bit of a cushion.
It does. It gives you an excuse to raise prices. Right. But at the same time, what you're seeing in the paper this week is a lot of companies are trying to tighten their belts so they can absorb some of it and sort of more incrementally increase, because a 25% tariff, theoretically, that's 25% price increase. That's a lot. If you can do it in increments of 10, 10, and 5, like maybe you absorb the first 20 early on and then slowly get to cover your costs later. And that's what people are actually talking about doing right now, is maybe tightening belts, which would slow the economy down, but being able to sort of slowly implement the price increases so the consumer doesn't get hit.
Well, I mean, look what the consumer got hit with over the past 5 years. So it's like, okay, the investment might slow the economy down, but if the consumer's not spending, which is 70% of our GDP.
Which is why everyone's talking about recession. Because if the consumer, if wages are growing much more slowly now, and so if inflation picks back up, maybe real wages actually go negative because the wages don't keep up with the inflation again, and suddenly consumers don't have as much real money to spend. And so we'll be buying less stuff. Companies will be selling less stuff, need less people to
My
make
gosh, if you're in the Fed right now, your head has to be spinning.
So I'm more about demand destruction at that point. If they do kind of front load it and they don't just tighten the belts and absorb the first part, whereas potentially more deflationary, we have these now massive amount of inventories that everything's been front loaded, so they're going to be sitting there, need to get offloaded, and if consumers are unwilling to pay an elevated price, then obviously those prices are going to come down because of demand there. So that demand destruction is another thing, again, for pointing towards potential recession. If the consumer's just not there to absorb it, they say, they're trading down or not in the market for certain goods or services at that point, it's just not worth it, with that 25% increase, you might see that more deflationary, I would think, than even inflationary.
It's interesting you say that because a lot of the models right now are actually saying in Europe it's going to be net deflationary because of the demand destruction. The US, because we're the ones putting the tariffs on, the tariff impact's more inflationary than the demand destruction is deflationary. But 100%, it's a push and a pull, and we will find out at the end of the day
Which
how
is why
it
we
works.
have two different central bank policies, right, for good reason. Let's talk about individuals for a moment here. What could happen with income tax rates, SALT? Will there be any revision to SALT, hopefully?
Yes, there will be a revision to SALT. What that revision will look like, I've seen 5 different versions of, or actually 6. There's a strong coalition of high tax states, including New York.
We are very well aware.
Yes, who will not vote for anything. In slim majorities, they have a lot of influence unless there's some relief with regard to SALT. So there's been discussions of raising it, doubling it to 20,000, at least for married couples. Right now it's just 10,000. There's been discussion of 25,000 that was knocked off, and there's also always on the table eliminating the cap altogether. But there will be a change. We have no idea what it's going to look like, but that's a powerful coalition.
What about the taxpayer, just in general, when it comes to income taxes?
Oh, so for taxpayers, so there's a concern. Well, extending the TCJA would provide the most certainty to everybody. Taxpayers are concerned that if the budget becomes an issue, if they have to find ways to cut, that they may in fact play with the rates and include maybe a higher rate, which has political implications, obviously, but those rates are looked at. So are deductions, cutting back certain deductions, whether it's mortgage interest, whether it's charitable deductions, whether it's standard deduction. All of that really is kind of on the table, and that's really in connection with offsets, finding ways to raise revenue. But right now, there's just nothing that's been other than just chatter in D.C. That's been in writing or discussed in any markups right now.
Can we just have a flat tax and call it a day?
Flat tax would be simple. We discussed earlier, definitely would be a simple approach.
All right.
Thank you.
Appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.